Hi, all. Welcome to Search for Yields, the weekly newsletter from INR Bonds. I am Arjun Patsarthi. And in this issue of Search for Yields, we are talking about the 10-year government security or the 10-year Gsec or the 10-year government bond, as you may call it. And we have a series, INR Bonds has a series called Bonds Decoded. We talk about all the understanding that you require to know about bonds. And in this 10-year decoded uh, issue of search for yields, we will talk about the 10-year Gsec and why it is so important to the bond market and to the economy as well. Now, coming to the 10-year Gsec, it is called a benchmark bond. So why is it a benchmark bond? Because it's a benchmark bond because one is it is the lead indicator of interest rates in the market. That means if the bond prices or yields move up or down, then bond markets view that interest rates are going up or down. And many bond market participants also take positions on this security based on their future outlook on interest rates. So it's a trading bond as well. And on the other hand, uh, uh, the a whole host of stakeholders, including investors, borrowers, lenders, government, central banks, and many are corporates, etc., all view the 10-year benchmark bond, take cues from the 10-year benchmark bond, as it is a lead indicator and very important indicator of interest rates. Now, for example, if investors believe that interest rates will fall, then they will look at whether the 10-year Gsec yield is moving down because it's a benchmark bond. Now, if there is a lender and they want to price loans, then they will look at the 10-year Gsec yield and where it is and how it has moved, and they will price their loans accordingly. If you're a borrower, again, to even look at what is the rate of interest you would like to pay, then you would have to look at the 10-year Gsec yield. So if all bond issuances, for example, corporate bonds, are all based on the movement of the 10-year Gsec yield. Even if they are not 10-year maturity issuances, many corporates look at the 10-year Gsec yield and price even maturities either less or more of their bond issuances based on the movement in the 10-year Gsec yield. The government itself looks at the 10-year Gsec yield, and if it believes that the Gsec yield is rising too fast, then it will have concern because it's borrowing through the 10-year Gsec and its overall borrowing cost is seen as rising. And if it falls, it's good for the government because borrowing costs are going down. And the RBI too looks at all its impact of the policies on that moment of the 10-year Gsec yield. So if the RBI raises repo rate, they would like to see what the impact is on the 10-year Gsec yield because it sends out strong signals in the bond market. Similarly, if the RBI reduces the rate of interest repo rate, then again, if the rate of the 10-year Gsec yield falls, then it is seen as RBI's policies are effective. And RBI in the recent times have also stated that whether good or bad, it's a debatable point, but they have stated that the 10-year Gsec yield is a public good. And many times they target the yield of the 10-year Gsec yield of the 10-year bond, 10-year Gsec. And this this maybe throw some doubts in the mind of the market whether it is truly a market determined price and yield. And if it is not truly a market determined price and yield, a lot of other things also can get affected due to this. So this is, as I mentioned, it is a debatable point and not for discussion in this understanding of the 10-year Gsec, but maybe in some other knowledge session, we can debate on this. And just to give you an example of the 10-year Gsec yield, the last 10-year benchmark bond was a 6.10% 2031 bond. It was issued in July of 2021. So given that its maturity is 31, it's a 10-year bond, and it's a 10-year benchmark bond. Now, so 6.10% 2000 GS 2031 is a nomenclature, and interest is paid semi-annually. That is, there are two interest payments every year. The dates are given, and then the maturity date and the issue date. And if you look at the amount of issuances, the government has issued rupees 1090 billion or 1.09 trillion of 10-year 6.10% 2031 bond. So the way it works is that the first time the government issues this bond, they allow the market to determine the coupon of the bond, which is 6.10%. And so basically the market bids on the yield here, which is the coupon. So if there is a new issuance of a 2010-year bond, for example, then the government, RBI will announce the auction and tell the market that you determine what yield you want to invest in this bond or buy this bond. And the market will say, I would like to bid at 6.10% or 6.05% or 6.15%. And depending on the collated bids, RBI will give a cutoff. And this in this bond, in this case, the coupon was cut off at 6.10%. But subsequently, every issue after that is a price-based auction. And so now, if the 6.10% 2000 bond price is always issued at the face value of ₹100 in the beginning, and in the next auction in the market, the bond is trading at a price of ₹99. In the market will again in the next auction, the bid will be in price terms, not in yield terms. So they will bid at price of say 99.20 or 98.80, any of these levels, depending on that. The prices could also go up to go above 100. So it could also be say ₹101. And again, markets can bid in the auctions at around the price levels. So that's how it's called the 610. Once it's issued in the beginning, then the bonds are reissued in subsequent auctions. And over the period, the government has issued close to 1.09 trillion of these bonds as of 16 November. So this brings us to how you need to view the 10-year Gsec. 10-year Gsec, and if you have any questions, you can always write to INR Bonds. Thank you very much for listening in, and do not forget to subscribe to our YouTube channel for all other videos that we put out on knowledge on the bonds. Thank you very much.